Join the Wide Whale team May 29th at 3 p.m. Eastern for part 2 of our 3-part virtual event series, Voice of the Resident. For part 2, we will look specifically at residency. Using AI topic analysis, we've analyzed the free text of 400,000 Google reviews from residents of hundreds of top multifamily groups, including the NMHC Top 50, to identify how often 50 key topics are mentioned by residents. By filtering for and analyzing the topics by life cycle stage, we can isolate which topics are more influential during residency, versus tour, or renewal. Go to widewhale.com/data to sign up or find it in the revised community. That's widewhale.com/data.
Welcome to another episode of Multifamily Collective. Today, I have the privilege of bringing you an episode with Ellie Pearlman. Ellie is the founder of Blue Lake Capital, has over a decade of experience in real estate investment, law, and property management. Ellie leads Blue Lake Capital, a private equity firm focused on multifamily assets. Historically, Blue Lake has owned and managed over 3,900 multifamily units across the United States with a $1 billion in transaction volume, a track record of 30% net IRR, 33% net AAR, and a 1.6 times net equity multiple to investors. BLC has also been awarded as one of both Financial Times and Inc. 5000's fastest growing companies in 2024. Ellie started her career in Israel as a commercial real estate lawyer, leading real estate transactions for Israel's largest development company. Later, as a property manager for one of Israel's most prominent oil and gas companies, she oversaw properties worth over $100 million. Ellie holds an MBA from MIT Sloan School of Management and a bachelor's and master's in law from Bar Ilan University in Israel. Ellie is a Forbes author and a real estate investing host of the podcast Ready to Scale Real Estate Investing, and the author of The Ultimate Guide to Creating and Preserving Your Wealth. Ellie, welcome to the show.
Hi, Mike. It's great to be here. Thank you for having me.
Yeah, definitely. This is a real pleasure for me. I have been following and tracking you for a very long bit of time. I'm a voracious reader, so I get your newsletter and I read that. And I know you wrote something recently that's a download and how to create wealth and preserve that over time. And so I'm super interested to dig in, but I'm highly honored that you would take the time to invest with us a little bit here.
Absolutely.
All right. So why don't we start with, a big topic like the market seems to be stable these days, right? From your perspective, is it stable or a little unstable? What is your take on the market presently?
It's a bit unpredictable, but less than it was a year ago. If you think about the environment we were in 2-3 years ago, rents kept going up, interest rates kept going down, and there was I think it was unpredictable in the sense that we didn't know when those trends are going to continue, for how long they're going to continue. Now we understand that interest rates, have gone up. Maybe the Feds are going to cut rates. We don't know when it's going to happen. We all assume it's going to happen towards the end of the year because of the elections. And we know that rents are kind of, multifamily rents are softening across the board. There's some markets with really significant growth, but this is not by any means the majority of the markets that we see right now. So there's more predictability, and there's a reason why I chose to talk about rents and interest rates, and that's because they're one of the two assumptions, or I would say factors that can make or break a deal. And it's amazing if you take a multifamily deal and you model it to hold for the next 5 years, and you model 2% rent growth year over year versus 2%, you can be the deal can be losing money at a 5%, then all of a sudden it's a home run. So it looks like a small change, but it really, really impacts the valuation, and same with the debt. 7% interest versus 3%. That can make or break a deal. And so there's more predictability right now in the market, contrary to what investors may be thinking or feeling. because we know what to look for right now, which we didn't know, 3 years ago.
Yeah, you couldn't be any more right. And I think it's like there's this perfect storm out there in the world, or there was a perfect storm out there in the world, and all these variables. And today, some of those variables are starting to come into view, and in sometimes clear views, so that you can actually make informed, well-informed decisions. I know that, or at least from my perspective, there's still a little bit of a when is the market going to actually break loose? When will deal volume start to trickle up a little bit? What is your thought as it relates to that? I've heard different things, so I'm interested in what you think.
For the past 18 months, the deal volume has really gone down significantly. A lot of
Mm-hmm.
sellers decided to hold on and hold off from selling assets because the interest environment right now is not very
Right.
not very creative when it comes to selling assets. If you can sell it when interest rates were at 3% and now they're at 6 to 7, that the impact on the valuation is tens of millions of dollars sometimes.
Right.
So unless you can you need to sell, you don't really you really didn't sell in the last 18 months. Right now, we've seen sellers making peace with the new pricing. It was hard for them
I
to
like the way you put
say.
that.
I mean, that's the truth. It was hard for them to say, well, if I put the asset in the market 6 months ago, 3 months ago, I could have gotten $50 million, and now I can get only $42 million. That's a hard pill to swallow. It's hard reality to face, and everyone was kind of waiting to see where things are going to shake out, and now they've made peace with it, that this is what they're going to make, and they don't see any major changes moving forward. So we see we definitely see more and more deals in the market because sellers, like I mentioned, they made peace with it. And I think this trend is going to continue, whether it's these are distressed assets that have to be put in the market, or sellers have made peace with the new reality. But that's the nature of the cyclicality of real estate.
That's right.
It goes up, it goes down. When it goes up, in the back of your head, that the music is gonna stop at some point.
That's right.
But you operate out of some optimism, and then when the music does stop, in my opinion, this is when you should be buying assets, because you're in a much safer environment when you know what to look for and you're more conservative. But the human the psychology is a bit different. When fear comes in place, it kind of it drives people and some investors to make the wrong decision by not participating in the market. But now we see assets that if we bought 2-3 years ago, we would have paid a lot more money for, and nothing really has changed in terms of NOI, just the value, because the debt environment value has gone down. This is when we can capture, the opportunities and actually buy smarter than we could have a few years ago.
So talk to me about that, buy smarter. For people who are viewing or listening, I love to ask individuals like yourself, like, everybody has their secret sauce, so to speak, but there really are some themes and some through lines. So I'm wondering what you define as being smarter about investments, especially in an environment like we're in today.
It's an interesting question. Being smarter, there are a few aspects to it. I tend to keep emotions out of business because I think it leads to wrong decisions many times. And so we heavily rely on AI-backed technology in underwriting. So we don't just hope that rents are going to grow at X% year over year. We look at reports, of course, and we have some data, but you can interpret data in so many ways.
Sure.
We use AI technology to actually look at the algorithm and calculate vacancies in the market, new deliveries, and at the property level, to essentially say, here's what the model predicts that occupancy, concessions, rent growth is going to be for the next 2 to 3 years. It's really hard for the model to look further than that. But
Sure.
in the immediate 2 to 3 years, then we have some independent benchmark that is many times that's a reality check. So that's something we've implemented in the last couple of years because we wanted to take the emotions and being the need to be um, optimistic in order to make the deal work. So we
Sure.
take that out of the equation. I think investors should when it comes to invest smarter, don't look at don't judge a book by its cover. So don't look at how nice the asset is, because the truth is how beautiful it presents. That means that there's maybe less of value add to invest, um, because then you can do the work and then push rates. If the asset is a bit too nice, then there might not be that opportunity that you're seeking for. So it's part of I would say that's how you invest smart, when you actually see the fundamentals and you're not attached to a certain asset. This is not your home. You're not supposed to go and live there. Um, so that's part of investing smart. And then on the flip side, it's also doing a lot of the due diligence before
Mm.
you even put an LOI in. And many sponsors, what they do, they have, some benchmark as to how much to look for, when it comes to expenses. How much is insurance cost per door per year? How much is payroll? What would be the property tax? But we actually do a lot of work with the companies that we hire. So
Mhm.
we don't need to estimate what the property tax is. We have tax advisors that are bringing that number to us. So it's another layer of security of really doing a lot of the work and digging deeper. By the time we get to the point where we're ready to submit an LOI, we've done so much work. It's unlikely we're going to be surprised once we get the deal awarded and start digging even further. So that's another aspect of investing smart.
I love the way you unpack that. And if I were to sort of juxtaposition that against, let's say the last 24 months plus minus, maybe it's longer than that,
Yeah.
but when there was so much free money in the marketplace, there were a lot of buyers, uh, very opposite of what you just described, that saw the pretty asset and or saw the big paycheck at the end, that didn't do all that DD work, that kind of underwrote on the back of a napkin at the local pub down the street and and had enough access to money that they could buy deals, right? I have to wonder, what is it about your organization or you personally that helps keep you disciplined to the process when so many times, to your point about human emotion, it's like, oh boy, this looks like a ton of fun, let's go do it, instead of being disciplined to the process? What is it in your organization or you personally?
There's a lot of things that I took from my previous life as a real estate attorney, and also what I've learned at my during my MBA studies at MIT, to
Mhm.
build a company that is well structured. And listen, no company is perfect. We're still
Sure.
refining SOPs and processes, but it was all created to go through um, certain process, and it's kind of a path from start to finish. I think it's also my personality. I'm very structured, and so that
Mhm.
helped, creating a company that is structured in that way and is disciplined. And it's hard. It's hard to sit there and see all your competitors buying right and left, and you're not buying as fast. But you have to stay, true to how you're conducting business. So it's kind of a combination of my own, I would say, character, and but also the my education that has brought a lot of structure into everything that I do. So I don't just do something and then figure it out. I create the structure, beforehand. It doesn't matter if you're in real estate, if you're in tech. I think you can get the okay results if you just, chase some shiny objects and just do things to to get it done and figure things out later. But if you structure it to begin with to scale, then it's just a different game.
I have to tell you, just for somebody who's been in the business for such a long time, 30 years myself, I admire your approach, or individuals like you who approach real estate investment in that way, because I've fortunately or unfortunately worked for others who are the wild, wild west, and just go out and they're deal junkies. Really, is what it
Yeah.
boils down to. And you could argue sometimes that's profitable and sometimes it's not. But um, I am interested as you look forward into the future as things start to break loose. Um, how are you sort of positioning yourself in your company to take advantage of? In my head, when it breaks, it's going to go fast. You're going to get this propensity to want to put emotion back into the equation. How are you going about setting yourself right now to get ready for that time where things are just going to go crazy?
It's a good question. One of the things that we do is that every month we underwrite all the deals that we own, and we
Oh,
look into whether we can exit early
yeah.
instead of just waiting and being married to the idea that this is going to be a 5-year hold, which we usually, look at deals this way. So we're being very proactive. Every once in a while, we're going to get a BOV, which is essentially valuation report done by the broker, and we get some quotes from potential lenders just to see if, hey, this is the right time after 2.5 years to exit. Well, maybe we projected 13, 15% IRR. And if we exit now where our NOI is and cap rate in the market is, actually, we can get 16 or 17 or maybe 4 or maybe 14% IRR. And now it's a time to exit early because we really
Mm-hmm.
don't know what's going to happen, in 3 years. Um, that's one way, of doing it. And we're always looking way ahead and we see, okay, what's going to happen? What are the assets needs in the next 5 months, 10 months, 12 months. So we're getting ready for all kinds of scenarios, whether we need to reallocate some funds, whether capex needs have changed. So it's all about planning ahead of time rather than being um, reactive to a certain issue as it emerges. But again, it's part of being more structured and making
Mm-hmm.
sure that we're looking at the asset, kind of doing 360 way ahead of
Mm-hmm.
time, so we have time to prepare for whatever is coming. And listen, we're still going to get, we're still going to be surprised. It's real estate. It's
Sure.
unpredictable, but you're trying to at least control what you can. And that's when you put it in kind of a certain process that has some cyclicality to it or some rhythm, more rhythm than cyclicality, then that's how you prepare for, any issues, any, unpredictable, hurdles that you may face.
I like that. I think it's again, to your point about human emotion, I hate to keep saying that, but it's to the extent that you can remove that by putting systems and processes in place, and then you can be married to them in the way of discipline. You largely remove that, and it yields you a better outcome on the other side.
Yeah.
I'm switching gears slightly. I know you're a big fan of Atlanta. I live in Atlanta, so every time you do something in Atlanta, I pay real close attention to it. What I'm interested in knowing what it is about Atlanta that you find attractive, and then what are other markets? Obviously, you're out in California. What other markets, I guess, aside from California, Atlanta, do you find attractive in this kind of the start of this next cycle?
Yeah, the things that I find very attractive about Atlanta are mainly it starts and ends with people. So Atlanta has seen a tremendous population growth in the last several years,
Mhm.
and because it's centrally located, it has comfortable. The weather is for the most part comfortable, right? It's not very extreme if you don't mind a little bit of humidity.
True.
Um, and the cost of living is pretty reasonable for what you're getting. Atlanta has grown, tremendously. It's there are a lot of submarkets.
That's right.
I like to be outside of the kind of downtown area where you see a lot of core products to areas like Duluth, for instance,
Hmm.
and
Hmm.
Norcross, and so other kind of markets that offer that are essentially you can find assets that are a bit cheaper,
Right.
but they do allow tenants to get a pretty good quality of living because they have all the amenities around them. They have access to employment. They have access, to hospitals, to services, to shopping. So it has become more desirable than to live in like a shoebox,
Yeah.
more centrally located area. So I find that attractive, and that in result brought. I mean, there's also a lot of companies that move there, and that in return it brings more people, more tenants, and that's the demand for our assets. But in addition, all these things actually led to rent growth in the past, I would say 5, maybe 6 years. We're seeing softening in rents. They're still growing, but at a much slower pace. But I can tell you that we had assets in Atlanta that we were able to raise rents, not recently, but we were able to raise rents by 59.5% and 40, I mean, 35%, insane numbers. Um,
Yes.
so that's also what is attracting, what's attractive for us to see rent growth and population growth because the demand is going to be there. So we have, there's enough people to knock on the doors to want to rent, an apartment, and we can increase rents year over year. Besides Atlanta, other markets, I would say, the Carolinas are very
Hmm.
attractive to us. Um, Arizona is attractive. Texas, the
Hmm.
competition is very fierce there. Florida is a good market. Just insurance costs are very high, and that
Yeah.
impacts the deals. And you probably know, I mean, insurance companies don't really like Florida, and if
Right.
they are willing to stay there, then it's the cost of quadrupled over 18 months. So that adds a lot to the expenses, and that's it needs to be a very very solid deal to allow enough cash flow for a deal to work in Florida right now. Um, and there are several other markets, but these are kind of the main markets that we like to be in, um, for the same reasons. We see people migrating to those assets. We see them growing. And that's why we like to buy there.
Yeah, that's I I've operated in I think all of those markets over the last 7 years, plus or minus, to include Texas. And you are absolutely right; it is fierce. there,
Yeah.
I think there are no landlocks to development in
Yeah.
Texas. So the constraints are all cut down, but I very much like them. I'm curious about Arizona. I guess the question I would have is in terms of headwinds, when we start into this next cycle, you're going to see all this delivery that's going to happen at the same time. So,
Yeah.
despite the drivers, there are some headwinds as it relates to new product. How are you thinking about that in those particular markets?
You need to know where to buy because it's a
Mhm.
misconception that there are new deliveries everywhere in the Phoenix market. It's incorrect. There are some markets where in a 5 mile radius there's very minimal deliveries, and this is where you want to be, for instance.
Mhm.
And another way of looking at it is to say, let's say I'm buying an 80s vintage product.
Mhm.
The new deliveries, even if they do the lease up, the delta between our rents and their rents is so significant that we're not really competitors. Now, it could be risky if they cut it even further and compete with you, then you have, I mean, your occupancy is gonna suffer. So
Sure.
you need to look at all the deliveries during the entire hold period. And when there are deliveries, we have technology that shows us how many units are going to be delivered each quarter of those 5 years. Then you need to model some impact on occupancy and rents, because maybe you will need to react to it by becoming more
Sure.
competitive. But if the numbers still work, then it could be a good deal. If you just assume that it's not going to impact us in any way, shape, or form, then that's riskier. Um, but after the lease up period, they push the rents up, and sometimes it's, if the area is growing, new deliveries actually improve the area, and so the valuation of your asset also increases because now it attracts better tenants. Then more coffee shops are going to be open, more employers are going to come and you know situate themselves close to where the quality tenants are. So it's not necessarily a bad thing as long as you
Mhm.
have you can sustain the lease up period. That's the period that is that could be tricky. And again, not all markets have a very high number of deliveries. We just bought an asset last year in the Phoenix market, and the asset is cash flowing handsomely.
Yeah.
And it's because there are not many new deliveries. There is actually a new building across the street. They competed with us for a short period of time, and now they've raised their rents again. But the area is strong. There's not three or four or five other buildings that are competing with us. And so you really need to understand where to be. So if you go to the downtown, to the kind of areas where the nicer assets are, then you're going to find yourself in the middle of a pretty fierce competition.
That makes sense. Where they're down in the kind of the central business district where you have all
Yeah,
these kind of neighborhood
exactly.
amenities that you can't match up. Yeah.
Yeah.
The, I'm curious. So you were attracted to real estate, to multifamily specifically. Something in your life was a catalyst for driving that, which I'm interested in. But as a follow-up question that I'll go ahead and ask now is, my audience ranges from very youthful, kind of up and coming multifamily, either operations, asset managers, et cetera, and or sort of old school guys like me who've been around for a very long bit of time. You were attracted to multifamily. Why? And what would you say to that up and coming person in multifamily as it relates to not only working in the industry, but investing? Talk about why multifamily is I'm a big believer in multifamily. I think it's a fantastic investment. Why do you think so? If you do, I assume you do.
Join the Wide Whale team May 29th at 3 p.m. Eastern for part 2 of our 3-part virtual event series, Voice of the Resident. For part 2, we will look specifically at residency. Using AI topic analysis, we've analyzed the free text of 400,000 Google reviews from residents of hundreds of top multifamily groups, including the NMHC Top 50, to identify how often 50 key topics are mentioned by residents. By filtering for and analyzing the topics by life cycle stage, we can isolate which topics are more influential during residency, versus tour, or renewal. Go to widewhale.com/data to sign up or find it in the revised community. That's widewhale.com/data.
Of course I do. I invest in all my deals. So yeah, of course, most of my wealth is in multifamily. I'll start with the second question.
Okay.
Multifamily is, essentially the demand drivers are very strong and they're getting stronger. So you have young people and young families more and more, they actually cannot afford homes, especially as interest rates are going up.
Right.
And cost of living is going up as well, or they don't want to lock themselves into a house. 30 years ago, if you're 25, 27 years old, you're probably married with one kid and you already have a house, or you're working your way saving to buy one. Today, if you're years old, you want to be in LA, and then you're going to get a job offer in New York. What are you going to do with the house that you just bought? You're
Right.
not going to buy a house. You're not going to do it. The marriage age has gone up because people now in mid 30s are getting married, not in their mid 20s. So something fundamentally changed in the American culture years and years, a few decades ago.
Mm-hmm.
And all these people, they want to rent, and they're looking for that class B, class A assets to live in. That's what fuels the demand, and it's not this trend is not stopping. It's getting stronger and stronger. And
That's
so
right.
that's why once the demand drivers are there, that impacts occupancy, it impacts rent increases, and of course manageable interest rates once we start getting the feds to cooperate with the investment professionals a bit, because when a lender is looking at a deal, they essentially they price the risk and they assess the risk, and interest rate reflects the risk. So in multifamily, risk generally speaking is less than retail or office, obviously. So interest rates in the same environment would be the cheapest for multifamily compared to other asset classes. So that's why I believe in this asset. It's something that also investors understand. We were all renters at some point in our lives.
That's
So
right.
it's easier for us to understand it, to understand how they think, what they need. It's easier to be connected with that product. Um, Whereas some investors may not really understand office or retail because it's a bit removed from their lives unless they go to the office. But again, it's a bit different. So that's why I believe in multifamily. Um, why I got into it, I really started from a very very different place in my life. Was born to a family that was financially, struggling. We got food donations and clothing. We got. I was wearing clothes that were donated
Hmm.
because my parents could not afford to buy us clothes. And so I was always looking. There was kind of a choice whether I'm the victim and I'm poor. My friends were like friends, laughing at me growing up. Kids can be very brutal and very honest.
Sure.
Um, and they made sure that I remember that I'm in the bottom of the food chain.
Hmm.
And I could fall into that place that I'm poor, my parents don't have money. Um, we didn't even have a TV growing up. And I don't think I've ever gone with my parents to a restaurant until I was maybe 18 years old. Or I could say, you know what, it is what it is. I need to make sure that I build a life for myself to get out of that situation.
Hmm.
So,
Hmm.
when I was young, I forget if it's 9 or 10 or 11 years old, I actually used to clean buildings to help my parents with a little bit of a little bit of money.
Uh-huh.
So again, it's a decision whether I'm poor and oh my God, I'm a kind of the victim mentality, or to say it is what it is. Now what do I do to get out of it? And I chose that
Hmm.
path. And for me, education was the way out. And so when I looked at families and people around me that were not in my close, circle, obviously, but those that were in the same, I grew up in Israel, so in the same country, in the same environment, and those who were extremely successful were all in real estate
Hmm.
or had real estate holdings, even if it wasn't their source, uh, the main source of income.
Understood.
And I said, hey, if it works for
Mhm.
them, this is the path. So I need to be in real estate. I wasn't sure in what capacity, how, what product. It took me years to get there. Um, I focused in my law degree, I focused on real estate and then took also real estate classes at MIT. And so I made sure that I had solid knowledge that it was applicable to real estate. And that's how I got into real estate.
I love that, and thank you for sharing that. It does prompt a question in me that I love leadership and I love company culture as it relates to leadership, and I have to imagine your culture is phenomenal just based on the fact that you just disclosed that here publicly. Um, what do you think that moment in time where you're sitting wherever it is and you're looking around the world and you're thinking to yourself, I can either just follow the path of least resistance and do nothing, or I can go and do this thing. So there's Viktor Frankl. I'm sure you know who that is. He has, it's the psychology of where the space between catalyst and response, there's this thing called choice, right? What
Yeah.
what was it that, whether it was internal or it was something external, what caused you to go, I'm not doing this path of least resistance, I'm going for it?
Mike, I wish I could say, oh, I'm just this great person and I, chose that path. I knew it was the right thing. I think many times you're born with certain traits and certain character that makes it easier for you because my siblings were born in the same house and they chose a very different path. So I have to thank luck, DNA.
Mm-hmm.
Part of it was also actually my parents that kept telling me you can do whatever you set your mind to.
Mm-hmm.
You have those abilities, and I heard it over and over that I can do whatever I put my mind to, and I believed in that because that's what you hear as a child. So it's a combination of that and just my how I was born with a set of certain traits that enabled me to go that way rather than, the other way. But that's the truth. I don't really know why else I did it besides those two factors that I think, contributed to it.
I understand. Thank you for sharing that. Is this where I know there are two ways to interpret chutzpah, but maybe the chutzpah in you like caused it.
Yeah. Yeah, in a sense. It's kind of being it's like kind of being I don't want to say rude, but it could be in a playful way also.
Yes.
So it's always like pushing it's always, trying to get, something, even you know that all the odds are against you, to see if you can actually get it.
Yeah.
That was also part of it. And I had back then in Israel, I had a mentor that taught me. Um I was an attorney that did some also project management at some point in real estate projects, and he taught me how to talk to people, how to get approvals, how to push my projects further by forming bonds with the people who made the decisions. So really, it got nothing to do with law or project management, but
Mhm.
that was really valuable. When I told him I was moving to America, he shook his head and he said, "You're not going to make it." I said, "Why? What do you mean?" He said, "Because you're not white American, and only these people succeed in America."
Huh.
And that was the last um, advice I ever taken from him.
Right. You
And
used to be my mentor.
I used to be, and I think, and this is something that I tell many people that reach out to me and want to get advice on how to get into real estate. I get a lot of those, and I'm happy to speak with them. I always tell people to get advice from those who have succeeded in the area that you're searching the advice, for. So if you have a friend that divorced 5 times and cannot hold, steady, cannot date someone over a few months without breaking up with them, you're probably not going to go to them to seek relationship advice, right?
Right.
So people who have never succeeded in real estate, started companies, they can never advise you on what to do. I mean, my friends and other colleagues before I moved here and went to MIT said, "You're crazy. You're crazy to leave, well-paying job and move to another country and take a loan to pay for your MBA. You can buy a house with that amount."
Hmm.
And but they've never, I mean, they've never started businesses. They've never, moved countries and started all over. So they cannot advise me on something that they've never done. So
So true.
yeah,
So true. It's that's sage advice. And some might argue that's obvious advice, but it's so hard to follow, right? Because of
yeah,
that thing we call fear. Fear gets in
yeah.
the way. It
It
keeps you
thinks it
from
protects us, though.
agreed 100%. Yeah, I think yeah, if you go way back, fear was there as a tool for you to stay out of danger
Yeah,
or to be eaten by an animal. And but today
yeah,
it's sometimes fear takes over and still tries to act that way when you still have a lot of evidence contrary to that. You can still move like
yeah,
you just moved forward and went for it.
yeah. I think for me, the fear is more about not taking a certain opportunity, not growing a company, because I think many people are comfortable in their place because they have a lot to gain, but also a lot to lose. And they're trying to balance that and say, well, yeah, I may be able to buy 1,000 units, but I'm going to have to sign on loans. I'm going to have to take the risk of raising money. What if I can't raise it? And I read somewhere that what separates average Joe from the very successful savvy businessman is that those people repeatedly were willing to take the risk without knowing exactly how they're going, what the outcome is going to be and how they're going to get there. And they they were comfortable figuring things out, knowing that they'll get there, but exactly how, I think a lot of people are trying to get all the answers from day one. They're not going to be there. Don't look for all the answers. You got to take a chance. You got to start taking action and be okay with a failure if you can't get there. Be okay with that. That if you cannot raise the money, you may lose a $250,000 deposit. Now I say it like it's nothing. It's a lot of money.
It's a lot.
But
Yeah.
that's
But
these are the risks that I had to take, knowing that there's plan A, B, C, D, and E. And if nothing works, this may be something I'll need to pay. And you always have to pay in business. Nothing, if you won 100% of the times, then everyone would own their businesses, right? Everyone would want to be that person. So it's just being comfortable with that, with the risk.
do you think, I'm curious, and hopefully I can articulate what is in my head
Yeah.
well. Do you think many times there's this fear of who I have to be in this new role to handle huge debt, huge responsibility, huge relationships versus who I am today, where I'm super comfortable, not challenged. And so there's a gap between who I am today and who I need to be for all these things. All those things that you mentioned, fear of loss of money, fear of loss of time, fear of loss of all this sort of stuff is fear in and of itself. But it's like this, who I have to become. And I'm not suggesting that's a negative thing, because that's a very positive thing in my head. Is that fear bigger than these other fears of what I consider a little more tangible things?
Yeah, I mean, it's essentially self-doubt. Can I be this
Yes.
person that I need to be? Yeah, and you're never going to know until you try it. Right now, if you don't do it 100%, you're going to be right. You're never going to become that person.
That's right.
That's 100% not. Yeah, but there are ways to mitigate that risk. So many syndicators that are just starting out, my advice to them would be, don't take a project from start to finish and try and do it all by yourself. Team up with someone that has the experience. Limit your participation in the JV in some way, shape, or form where you feel comfortable that you can deliver, when the upside is maybe not as great as if you have done it by yourself, but the upside is significant or meaningful, but the downside is limited because you're not doing it all on your own. Do it once, twice, three times. You'll grow, and then you'll see whether you can do it. So in that sense, there's a way to manage it. It's not all or nothing.
Right.
It could be all or 20% of it, or 15%, whatever you're comfortable with. I definitely saw people that started when I started, um, and they still were holding on to their jobs. They did not want to let go of their well-paying jobs. And I understand it. I mean, listen, they had mortgages to pay. They had, children to support, a wife to support. It's scary. It's scary to do it.
Sure.
And some of them are not in the real estate business anymore, or they're still in the same place. Even those who have left their jobs, but they were unwilling to invest money in the team. Hire underwriters, hire asset managers, hire support staff. They're doing the same size of deals, and their growth is pretty flat.
Mm-hmm.
Even though they're doing it, I mean, they're still underwriting their own deals. I cannot underwrite my own deals if I want to grow the company. Plus, they're much, much smarter. I can tell I'm the least smart person in the room. I have such smart, strong leadership team, analysts, underwriters, acquisitions managers. They know how to underwrite in the way that I would need a lot of years to practice, but I pay them well, so they can support, the organization. So that's how you grow also.
Yeah, it's so true. You have to have people around you. If you're
Yeah.
entering into this thing for the first time in a sort of the deal way, you've got to have smart advisors around you. Not only, it's like, here are all the things you should not do. Here are all the things I learned the hard way. Stay away from that stuff. You'll be successful, maybe a little more swift than I was. And then surrounding yourself internal to your organization with very smart people. I also have to imagine, and I'm asking this from an operator's perspective. You have to partner. You don't manage your own deals. Is that right? Like, you have to look for partners out in the marketplace to manage your deals, or do you
Define
self-manage?
manage.
Property manage, the property management arm of
Yeah.
multifamily.
The people that are sitting in the office, in the leasing office, the leasing team, the maintenance teams, they are third party. But we are in our roadmap. We are transitioning to integrate that aspect in the Blue Lake operations. That's the next step.
Yeah, that makes sense to me when I think about the future landscape of multifamily, and especially as it relates to capital that is attracted to multifamily. They like the idea of the fully integrated platform where
Yeah.
you're kind of controlling the real estate, so to speak, and from all aspects.
Yeah. Yeah. But, there are downsides to do it as well. So you have to make sure that you're um, executing in the best way possible, and
Yeah.
overcoming those challenges. The grass is not always greener, but the truth is no one's going to care about your assets more than you. And when you start a property management arm, but ideally not provide services to other sponsors, so the team's sole focus is your asset, that can definitely contribute to the bottom line, in a much more significant way than if you hired a property management company, a third party.
Yeah, that's right. I've worked in both of those environments, and this is not my novel thought, but somebody said this to me one time. I like it when I can get up out of my chair and I can walk down the hall and I can, talk to the guy or the gal that's responsible for X, Y, or Z, as opposed to picking up the phone, getting
Yeah.
some lip service, and
Yeah.
I'm on to the next meeting, so to speak. So,
Yeah.
I'm interested in the future. Obviously, you just disclosed a little future piece there, and I think that's awesome. In one guy's opinion, I think that's a right strategy. Uh, what are you envisioning 5, 10, 15 years down the road as it relates to your business, or even tech that's impacting your business, or even more broadly speaking about the industry? What do you see out around the bend?
I think AI is definitely going to play a much more dominant role in
Mm.
real estate. I mean, right now we're using AI in underwriting. Um, we are using AI in asset management. So, for instance, we have technology that not only analyzes the rents that we have daily pricing, everyday pricing changes, but also we are using AI to assist the current team in collecting rents. For instance, it's a bot that speaks and behaves like a human, and it learns how the team uh, speaks and adjusts their tone accordingly, and it's helping to collect rents. And people think, renters think that they hopefully not listening to this episode, but they think they're with a human, and they say, well, I spoke with so and so, I texted so and so, and I wired the rent. So that's something that is also very helpful. And also, we use it with investor relations and marketing, and so we're integrating um, AI as much as we can, but there's still a lot that could be done. So I think that in the next 5 to 10 years, AI can significantly increase the productivity and the um, I think it's going to streamline the acquisitions process, and it's going to touch on every aspect of real estate. It's just historically real estate has been an industry that has been lagging when it comes to technology. There's some resistance there, maybe because the nature of brick and mortar that is just harder harder to implement technology on. But I think that's going to be one trend that we're always um, keeping a close eye on, and we like to try different approaches to become better, to gain advantage over the competition. For Blue Lake, the goal is to grow the company, bring more investment vehicles in. Right now, we are focused on multifamily. Um, and we have a fund, Blue Lake Multifamily Fund, that is open. That's another focus for us to hopefully close the fund, um, probably in several months or so. But that's the focus. The focus is really to grow the portfolio, to partner with more investors, and to make sure that we're hitting all the projected returns.
I
That would be
I
the
love
focus the next 12 months. Yeah.
definitely. I I got to tell you, I know I opened by feigning my admiration for you. But I do mean it. I think that you are doing something special in the marketplace. I don't see a lot of individuals like yourself who are branding not only personally but also on behalf of the company, like willing to put their face out into the marketplace. And so I think that what you're doing is amazing. I love reading about it, the way that you articulate it in your blog posts, and I look forward to them. And so anything that we can do to help here from the Multifamily Collective. I also have a media company, Multifamily Media Network. Anything we can do to help promote that, we're absolutely willing to do that, and we appreciate you. Thank you for investing some time with us today.
Yeah, absolutely, Mike. And if someone is listening to this conversation and is interested in discussing investment opportunities, Blue Lake Capital, just Google us. There, you can read a lot on the website. There's a lot of good, valuable information. Um, and you can leave your information there and we'll get back to you. We're always happy to speak with investors, understand what they're looking for. We have a pretty solid opportunities right now. So happy to chat with investors.
Awesome. We'll link all that information up in our show notes. And Ellie, thank you again. Appreciate you, and good luck to you as you move forward. And for everyone else, thank you for tuning in today.
Thank you, Mike. It's been a
Bye
pleasure.
now.